Barizenyu. I hope you have prepared yourself psychologically for consolidation. What's consolidation? What's to consolidate? No? Yes, it's to combine. So now consolidation in financial reporting occurs where there is a parent and subsidiary relationship, where now in this case, you have to consolidate or to combine the financial statement of the group of the company. This happens where we have company A. This is the parent or the holding company. And then company A acquires another company. Let's call it B Limited. More than 50% of its share to 100%, even can acquire 100%. That means it's wholly owned subsidiary. Let's assume A acquired B 90%. Now the company being owned by another company, more than half of its equity is known as the subsidiary. Then if A acquires B 90%, that means there is a proportion of 10% in B, which is not being owned by A. That's 10%. What do we call this 10%? Yeah, that's the non-controlling interest or the minority interest. Also, the parent company can acquire another company, call it C Limited, between 20% of its equity share to 50%, 20 to 50. So let's assume A acquired C 40%. Now this is what we call an associate, or if the entity owning C, they have joint control, it becomes a joint venture. Joint venture. So now that's what brings about the group relationship. Where you have one company known as the parent of the holding company, and then we have subsidiary and other investments. So we are saying that for it to be a subsidiary, the company must own more than half, not half. So if A acquires B 50%, that one does not qualify to be a subsidiary. That one is merely an associate or a joint venture. Now, another difference between a subsidiary and an associate is that for a subsidiary, the parent company can control. Yeah, that's another element you need to identify what qualifies to be a subsidiary. If the parent can be able to control the subsidiary, so in this case, you're saying that the subsidiary can be controlled because the company or the holding company has more than half of the share. That's how you get the voting power. Now, in associate, A cannot control C, but they can exercise what you call a significant influence. They can have an influence. So we have a significant influence. They say that for it to be an associate, it should be between 20 to 50%. What if the company acquires another company, 15% of its share? So that one is not a subsidiary, it's not an associate. That's a merely available for sale. Are you together? Yeah, that's an equity investment, qualified to be a financial instrument. Good. Then now let's look at what we call the group structure. And we have 3 types of group structure. Number one, we have horizontal structure. And the horizontal structure, this is where the parent company has more than one subsidiary. You have A Limited, A acquired B, 90%, A acquired C, 80%, A acquired D, 75%. That's what we call a vertical structure. But the parent company has more than one subsidiary. All the subsidiaries are under one umbrella holding company. Then number 2, we have vertical structure. Now in vertical structure, we have the parent company. This is the holding company. And then the holding company acquires another company. Let's call it B. Let's assume 90%. So who is B? Comes a subsidiary. And then non-controlling interest, if we control 90% of B, the non-controlling interest will be 10%. Then the subsidiary acquires another subsidiary. So B acquires another company. Let's call it C. Let's assume 80%. So that means C is a subsidiary to B, of which B itself is a subsidiary of A. So C becomes a subsidiary. subsidiary. Now, in this case, who will prepare the consolidated financial statement? Who will consolidate the financial statement? A, the parent. Which parent? And also B is a parent to C. Are you together? So in this case, it's A who will prepare the group account. Now the question is, A controls B directly 90%. Also, B controls C, but B is owned by A. So how does A now control C? If B can control C, also that means its parent can also control subsidiary. And this is a control, 90% of 80%. So 90% of 80%. And that one you get an amount of 72%. Then uncontrolling interest in C by A is how much? NCI will be 20. Good. And then number 3, we have what we call a mixed structure. Mixed structure. Now, for mixed structure happens where we have the parent company, A acquired B, 80%. So that means B is a subsidiary to A. Then the parent company also has another subsidiary. Let's call it C, acquired 40%. Then, so C is an associate to A. B is a subsidiary to A. Then the subsidiary decided to acquire some shares where the company or where the parent company has some interest. So B acquired some share. Let's assume 25% of shares in C. Therefore, who is C? Now, C can either be a subsidiary, can also be an associate. So how does A control C? A controls C, number 1, directly, 40%. Also, there is an indirect control. Indirect. A can also control C indirectly through whom? B. That is 80% of 25%. 80% of 25%. You get an amount of 20%. So how much is the total control? 60%. Therefore, who is C? Is a subsidiary. Good. So now those are the 3 types of group structure: a horizontal structure, a vertical structure, and a mixed structure. And then at the end of the year, the parent company needs to prepare the consolidated financial statement. That means you consolidate the financial statement of the parent company and the subsidiary. Note that we don't consolidate associate. We only control the subsidiary. For associate, we don't consolidate. We account for it using the equity method. That's under IAS 28. Good. Then we're saying that in this case, the parent company need to prepare the consolidated financial statement, but there are some circumstances where the holding company is exempted from preparing the group account. You are a parent company, but there is a time it's required for you to prepare the group account. It's a legal requirement. But what are some of the circumstances where an entity is exempted from preparing the group account? Number 1 is when the parent company itself is a subsidiary of another company. Now, for example, in this case, A is the parent, B is a subsidiary. Then B acquired C. Now, to C, who is the parent? It's B. So that means C expects B to consolidate the financial statement. But in this case, B will be exempted from preparing the group account since itself is a subsidiary of another company. So in this case, A will require to prepare that. That's one of the circumstances. Then number 2, when the parent company, it's a private company. A private company, it's not a must, they have to prepare the consolidated financial statement. But if it's a public limited company, that means has been listed in NSC. It's a legal requirement. They have to prepare the published financial statement, and in case you have other investment, to prepare the group account. And then another circumstance is when the parent company is an investment entity. We have some companies which are registered as investment entity. That means their work is just to provide capital to various companies. So that means, for example, if we take a case of Centum are a lot of investment. And you see, number 1, for you to consolidate the financial statement, you must use the same or the standard accounting policy. Now, if you're an investment entity, that means you provide capital So in a well-diversified portfolio, you'll not invest in the same industry, right? For you to minimize the risk. But for you to consolidate, you must use the uniform accounting what? Policy. So if you have, for example, you have invested in 50 companies, how can you consolidate all this? And you're saying that since you want to achieve portfolio diversification, you have invested in different industries. So therefore, you cannot be able to consolidate. So in this case, they'll be exempted from preparing the consolidated financial statement. Good. Another thing, if one company acquires another company, what do you call the difference between the purchase consideration and the net asset acquired? Good. Called goodwill. So how do we get the goodwill? We're saying that goodwill is the difference between the purchase consideration and the net asset acquired. And we have two methods of computing goodwill. Methods of determining goodwill. Number one, we have the full goodwill method. And number two, we have partial goodwill method. Also under IFRS 3, it also provides on how to account for NCI. So using the full goodwill method, we measure NCI at fair value. We're using the partial goodwill method. How do we measure the non-controlling interest? So for the non-controlling interest, use at proportionate share. Proportionate share of the subsidiary net asset. Now, what's the difference between the two? The difference between the full goodwill method and partial goodwill method. Now, in full goodwill method, in this case, you determine the goodwill of the subsidiary as a whole. That means the parent proportion and the subsidiary proportion. Sorry, I mean the parent proportion and the non-controlling interest proportion. But for partial goodwill method, you only consider the parent proportion of goodwill in the subsidiary. What does it mean? X acquired Y 90%. When the net asset of Y or the market value of Y was 100 million. Then the offer price or the purchase consideration paid by X paid 105 million. To acquire the net asset worth how much? 100. So if you're now to determine the goodwill using the full goodwill method, you'll take the purchase consideration, which is 105, you minus the net asset acquired, which is 100. So how much was the goodwill? That's what we call the full goodwill. What about the partial goodwill? Partial goodwill, you take 105 minus, you only take the parent proportion. Of the 100 million, we only acquired how much? 90%. So you only factor in the 90% of the goodwill. So in short, this 90%, you're only taking the parent proportion. But you see, for full goodwill method, you took 100%. That means the parent proportion in the subsidiary as well as the non-controlling interest. That's the difference between the two. So therefore, how do we determine the goodwill? Determine the goodwill, you will take the purchase consideration. Purchase consideration. Then you raise the net asset acquired. How do we get the net asset acquired? Net asset is assets minus liability. But one thing you have to note is that you might be determining the goodwill after acquisition, maybe after 3 years. Net asset is asset minus liability. Asset keeps on changing. Non-current assets will be affected by acquisition, disposals, depreciation. Current assets, they keep on changing. Current liability, they keep on changing. So how do you get the net asset? It's asset minus, which is equivalent to what? Equity or the capital. This is the general formula of getting the capital. Capital is asset minus liability, of which the capital is the same as equity. So in this case, for consolidation purposes, we use the equity element because most of the equity elements are constant, such as ordinary share capital, share premium. They only change when they only when there is issue of share. So you'll be taking the equity element where you have the ordinary share capital. Also, you take the share premium. and then you take any other reserve. Reserves keep on changing. For example, retained earnings. Retained earnings keep on changing every year. Why? Due to changes in the profit for the year. So when determining the goodwill, you take the pre-acquisition retained earnings. So how much is the retained earnings at the date of acquisition? Also, in case there is any other reserve, such as revaluation reserve, you also take at the date of acquisition, pre-acquisition reserves. All that. So that means the difference between the purchase consideration and the net asset acquired, that's how you determine you are good. So take out your notes. Discuss what you have in our notes. Page 1 of the notes. Business combination or consolidation of group. Now, consolidation or business combination refer to bringing together of separate entities into one reporting entity. The result of all business combination is that one entity, the acquirer, obtain controls of one or more other entity. Yeah, business combination brings about the parent and subsidiary relationship. So what do you mean by a subsidiary? Now, subsidiary is an entity that is controlled by another entity for more than 50% of equity share. Can you underline more than 50%? More than 50%. So if company A acquires B, 50%, that one does not qualify to be a subsidiary. That's an associate. For it to be a subsidiary, must be more than half. And then what do we mean by control? Because we say that parent can control subsidiary, but cannot control the associate. For associate, you can only influence them. What's the difference between controlling and influencing them? Significance, influence. Unaweza toa maoni, lakini maoni yako inaweza kuwa haiko valid. Are you together? What about control? You dictate. Like in this case, I'm controlling you. You have to do what I'm saying. But I can ask a question, you answer. You have a significant influence. It can be correct, can be wrong. Be wrong. But what I say here, it should be correct, and you do what I say. Now that's the difference between control and significance, influence. So that means you are my subsidiaries. Then what do you mean by control? Now, this is the power to govern the financial and operating policy decision of the investing. Now let's go to the last bullet, non-controlling interest. What do you mean by NCI? Now, non-controlling interest is the proportion of net asset in the subsidiary that's not owned by the parent company. Right in bracket, minority interest. Yeah, that's why I had requested you. I had been doing the campaign for the last 3 days. You make sure you have the hard copy because I want you to be making some changes. If you're using a soft copy, also you can adjust. Yeah? Then IFRS 3 allows 2 alternative methods of determining ACI. So how do we measure NCI? How do you measure the non-controlling interest? Now, when determining non-controlling interest under IFRS 3, it also depends with the method you want to use to determine the goodwill. So number one, you can measure NCI at fair value. So at fair value, use it when you're using the full goodwill method. Or number two, okay, let's go through that. IFRS 3 allows 2 alternative methods of determining NCI. One, NCI at their proportionate share of the fair value of the subsidiary net asset. Can you write in bracket, just for you to remember? Partial goodwill method. Partial goodwill method. We use that method when we are determining the goodwill using the partial method. Then number two, NCI at fair value. At fair value, right in bracket, when using full goodwill method, when using the full goodwill method, when using the full goodwill method. Good. Then we have the group structure. I think I've explained everything. Now there is a point for you to note there, NB. Only subsidiary is consolidated. Yes, we don't consolidate associate. For associate, we account for it using the equity method. Only subsidiary is consolidated, and for the ordinary share capital and share premium, only for the parent is recognized. So in short, we don't consolidate ordinary share capital and share premium. We don't consolidate ordinary share capital and share premium. You only take for the parent. Good. Then preparation of consolidated financial statement. The parent company prepares a consolidated financial statement using uniform accounting policies. Can you underline that? Uniform accounting policy? Using uniform accounting policies. However, the parent need not to prepare consolidated financial statement due to the following. Yeah, what are circumstances where the parent company is exempted from preparing the group account? I had already mentioned them. Number one, you see that when the parent company itself is a subsidiary of another company, when the parent company is a what? An investment entity, and when it's a private what? Company. Yeah, number one. When the parent itself is a wholly owned subsidiary or partially owned subsidiary of another entity. Number two, if its debt or equity instrument is not traded in the local or foreign public market. What does that mean? Private, adika for private. Get that in your notes. Private company. Then it's an investment entity. Good. Just know the first three. Then we have goodwill on acquisition. How to determine goodwill? That's under IFRS 3. Now, IFRS 3 defines goodwill as a future economic benefit. Future economic benefit arising from the assets that are not capable of being individually identified and separately recognized. Now, for example, when you're running a business, what are some of the things that you consider them to be intangible, apart from the net asset? If you value the net asset, you find that the value is worth 3 million. Sometimes you will not set the business at 3 million. What are some of the things you consider? For example, assume that you have a restaurant, you want to sell your restaurant. Apart from the assets, the tangible asset, what else do you consider? Number one, you look things to do with brand, right? What about location? What about the customer base? Yes, customer base mostly is that brand. And those are the things you consider, because apart from giving you the asset, you also have another asset we are considering. We had already an existing customer of which you inherit them. So that's part of what gives rise to the goodwill. So it's also the difference between the purchase consideration and the net asset acquired. It's computed as follows. We have that. Now let's look at the method of computing goodwill. Number one, you have the full goodwill method. And this is where the goodwill of the subsidiary is determined as a whole. Can you understand that? Is determined as a whole. The goodwill of the subsidiary is determined as a whole. The goodwill will comprise the parent and NCI goodwill. Under this method, NCI is measured at fair value. Also underline that. NCI is measured at fair value as determined as follows. Now let's go to number 2, partial goodwill method. Partial goodwill method. This is where only the parent goodwill is recognized. So you only recognize the parent proportion goodwill. And the NCI is measured at their proportionate share of the fair value of subsidiary net asset. Underline that. Proportionate share of the fair value of the subsidiary net assets. Determined as follows. So we have that. So now let's look at investment in associate. That's under IAS 28. investment in an associated joint venture. So an associate is an entity over which the investor has a significant influence. Underline that, significant influence. There is a significant influence. What do we mean by significant influence? We look at what do we mean by control. Now, this significant influence. What do you mean by significant influence? Significant influence is the power to participate in the financial and operating policy decision of the investee. Now, where an entity holds between 20 to 50% of the voting power, that's the equity, directly or indirectly, it will be presumed to have a significant what? Influence between 20 to 50. Good. If the voting power is less than 20%, it will be presumed to have no significant influence, and hence it will be recognized as a what? As an investment. Can you write in bracket? Available for sale. Available for sale. Available for sale. Yeah, that's under IFRS. If the company buys shares of another company, that's an equity investment, of which you expect some contractual income, such as dividend and the capital gain. Good. So the existence of significant influence by the entity is usually evidenced by one or more of the following ways. Number one, how can you exercise significant influence? We say that control, that means you are controlling them, you are dictating them. What you say is final and conclusive. But significant influence, you said, is what? Just giving an input which can be considered either correct or wrong. So number one, representation on the board of directors of the investee. Also participation in the policy making process, including the dividend policy. Also material transaction between the entity and the investee. Interchange of management personnel. Number 8, we have provision of essential technical information. Good. So how do we account for associate? Now, IAS 28 revised requires associate companies to be accounted for using the equity method. You see that you don't consolidate associate. You only account for them using the equity method. And this is how we apply equity method under IAS 28. This is where you recognize the investment initially at cost, and then subsequently you adjust for it for the post-acquisition changes in net asset. So you take the purchase consideration, or the cost of investment. That's at initial recognition. And then you adjust for any post-acquisition changes in net assets. So you add post-acquisition changes in net assets. And mostly what changes is the retained earnings. For example, assume that A had acquired B 30% when the retained earnings of B was 100 million. Then at the reporting date, the retained earnings is 120 million. At the date of acquisition was 100. At the reporting date is 120. So there is a post-acquisition change of by how much? 20. So in this case, you take 20 times 30%. You're only controlling them 30%. That's what you say, that you add post-acquisition changes in the net asset. Mostly what changes the retained earnings and the revaluation reserve. Then being an asset, you also need to evaluate for impairment test. And in case there is any impairment loss, to reduce the value of your investment. So you raise the impairment loss. Now what you get here is now what you recognize in your financial statement as part of non-current asset. Good. So now let's go through the equity method. I'm saying that this is a method of accounting whereby the investment is initially recognized at cost and adjusted thereafter for the post-acquisition changes in net asset. Is determined as follows. So the formula is not there. You just look for a place where you write this formula. So now we are back. Now let's look at exemptions from using equity method. When is the company exempted from using the equity method? So let's be here. It's good to read that. So you see that when you use the equity method, when accounting for associate, right? When you have a what? A significant what? Influence when between 20 to 50%. Now assume A was controlling B 30%. So that means B is an associate. But during the year, A acquired an extra 25%. So how much is the total control now? 55. That means it ceases from being an associate to a subsidiary. Automatically, it ceases from using the equity method. It was controlling that, but it disposed half of it, of the investment. So how much will be the residual? 15. It becomes a what? An investment available for sale. It will cease to use that. Let me repeat again. What's the difference between a subsidiary and an associate? The control element. Are you together? Take out your past paper. August 2022. August 2022. Question. Sorry, not August, but December. December 2022. Question 3. If you don't have, you don't have to worry. Someone to give me that I don't have. I read. Okay, let me read for you. It's nothing that much important. It's something you can listen. December 2022, question 3. Now let's go to additional information number 2. Additional information number 2. Number 2, you're told that M Limited is the main competitor of H. And on 1st of May 2022, if you don't have the past for just reason, M Limited is the main competitor of H. And on 1st of May 2022, M Limited and H Limited each acquired 50% of the 200 million ordinary share of shillings 10 each in L. Here we have L. Then we have two competitors. They are competing. So we have H and what? M and H. Both acquired 50%. Who is L to H? It's an associate. Also L, it's an associate to L, correct? Then you are told that. Let's go to the second paragraph. The second paragraph. Upon the acquisition, H Limited had a contractual right to appoint 60% of the board in L. H has the contractual right to control 60% or to appoint 60% of the board. That means, because it's 50-50, so that means M will control how much? 40%. Good. Now, that's all the information I wanted. Watu walianguka? Watu walianguka? Actually, this one was very easy to mark. You just look at the statement. You don't read actually. Just look how they have consolidated. You just cancel. Will you consolidate L or not? 50%. Will you consolidate or not? We see that we only consolidate subsidiary. Don't consolidate what? Associate or joint venture. Now, in this case, they have a joint control. So that means L actually it's not an associate. It's a what? It's a joint venture. Joint venture and the associate are the same in accounting. So will you consolidate or will we consolidate or not? Good. So 20 marks in the end. You consolidate because how do you gain control? How do you gain control? Yes, I have 50%. Are you together? You have 50%. But all the key decisions are made by the board, and I'm the one appointing 60%, of which H was the parent company. H is the one controlling 60% in L. So they don't have a significant influence. They have the control. Are you together? Good. So you do the full consolidation. You don't use the equity method. You do the full consolidation. Another scenario. A acquired B 60%. B acquired C 70%. Who is A? Parent, correct. Who is B? Subsidiary. Who is C? Subsidiary, correct. Now, A controls B 60%. So that means the non-controlling interest is how much? B controls is 70%. So that means C is a subsidiary to who? Who will prepare the consolidated financial statement? A, good. How does A control C? A controls C 60% of how much is that? 42%. Who is C? Very wrong. C is a subsidiary. No, I have to teach you some things here. Eh? C is a what? A subsidiary. Now, let me explain something. A controls B. Are you together? B controls C. Because C is a subsidiary to B. If the subsidiary can control the subsidiary, even the parent can control it. This was just an indirect control. Are you together? 42 is not the real control. This is just an indirect control. If B can control C, also its parent can control it, because that means all the capital invested in C was provided by the parent. I give you another scenario. A acquired B 90%. B acquired C 50%. Who is B? Subsidiary. Who is C? It's an associate. Are you together? How does A control C? 90% or 50%, you get 40? 45. This was 42. This is 45. Who is C? Is still an associate. Are you together? Now, if the subsidiary cannot control C, even the parent cannot control it. Are you together? Yes. Don't dwell on this. So I think now we have discussed all what I want us to discuss. So now we are looking at discontinuing the equity method. Yeah, the use of equity method ceases, number one, from the date significance inference or joint control ceases. Number two, if the investment becomes a what? A subsidiary. And then if the retained interest in the financial asset, that is interest is less than 20, it becomes unavailable for sale. Then we have what we call joint venture. Now, a joint venture recognizes its interest in joint venture as an investment and shall account for this investment using the equity method in accordance with IAS 28. So how we account for joint venture, and that's what is the same. Then we have what we call joint arrangement. That's under IFRS 11, joint arrangement. What do you mean by joint arrangement? This is where the parties into consideration, they have an agreement. So this is an arrangement of which two or more parties have a joint control. Can you understand that? Joint control. Have a joint control. What is joint control? Now, joint control is a contractual agreement of sharing control. At most it happens if you have 50%, control 50%. If you have 30%, you control 30%. But you see, in this case, it was a special case. They agreed that give me the power, I control 60%. What does that mean? Yeah. Also, you have some companies like that. The company might be having 5 directors. Of the 5 directors, there must be a balance. You find that there was a decision supported by 3 directors. And then there was another 1 director. One was very silent. He decides to support this 1 director. So that means we have 3 against what? And automatically, this 1 director will win the motion. It happens most of the company. It's not about the democracy. We have that director who is very key. So that means he can control the decision. Yeah. So in this case, this was a very special case. They were controlling. So now let's look at types of joint arrangement. We have 2 types of joint arrangement. One is a joint operation. Now for joint operation, the parties will have right to asset and obligation to liabilities. Also, we have joint venture. For joint venture, you only have the right to the net asset. That's the difference between the two. So you're saying that a joint operation, this is an arrangement whereby the parties that have joint control have rights to the assets and obligation to the liabilities. What about in joint venture? This is a joint arrangement whereby the parties that have joint control have right to net asset. Can you understand that? Right to net asset. Right to net asset. Good. And then we have various forms of joint venture. So I want us to take a small break. Then we discuss something very important. And kindly make sure you have the hard copy of those notes, because that's what we'll be discussing in the next 2 or 3 classes. So now let's look at specialized transaction. And number one, we have what we call the intergroup balances. Now for the intergroup balances, it mainly deals with the adjustment of account receivables and account payables. How do we adjust for this? Intergroup balances are eliminated from both account receivables and account payables. Now take a scenario whereby X is a subsidiary to Y, or X acquired Y. So that means they're in the same group, but the two of them they are business. So that means they can do some transaction. And during the year, A sold goods to Y on credit worth 100 million. X sold goods to Y worth 100 million on credit. So how will that affect our balance sheet, not the income statement? X sold goods to Y worth 100 million on credit. So X will record a transaction of 100 million as what? As good as account receivable. We are talking about the balance sheet. That's receivable. What about in books of Y? Y purchased good from the parent company on credit. We record an amount payable, the same amount, which is account payable. Now, what will happen now? At the end of the year, the parent company is preparing the group account. We are consolidation. One transaction, I'm showing it as an income, as an asset. In your books, we are showing that as a liability, but the same transaction. So what happens during consolidation? We eliminate them in full. So that means in my books, from account receivable, I eliminate the 100. In your books, we eliminate an amount of how much? 100. That's how you consolidate. And if I'm showing this transaction of 100 million, also in your books, you must be showing the same because it was the same transaction. What if now you found that in my books, I'm showing 100 million, but in your books, you're only showing 60 million. How much is the difference? 40. Now, this 40 arises as a result of cash in transit. That means of this 100 million, you wrote a check for me worth 40 million. That means you adjusted. That's why you're showing an amount of how much? But this check of 40 million has not yet been presented to who? Okay, that's how you account for it as cash in transit. Now, taking the same scenario, in your books, you are why now? You're saying that you eliminate from account receivable and account payable. How much will you eliminate from your account payable? During consolidation, an amount of 60. What about in my books as receivables? 100 or 60? 100, correct. So in your account payable, you eliminate 100. In my books receivable, I eliminate an amount of 100. Then there is this difference of 40. You see, I was expecting some cash. I have not received the cash. There is some cash in transit. So that means also my cash has been understated. This 40, you take it to part of cash and bank account. So that's the intergroup balances. Number two, another special transaction is intergroup sales and unrealized profit on closing stock. So now here you have two transactions. One is how do you adjust for the intergroup sales? And then in case of unrealized profit on closing stock. So intergroup sales are eliminated in full from both sales and cost of sale. I repeat again, that intergroup sales are eliminated in full from both sales, eliminated in full. Regardless whether you sold some goods, it should be eliminated in full from both sales and cost of sale. Now let's use the same scenario. X sold goods to Y worth 120 million. Sold, whether on cash, whether on credit. How will that affect the income statement? X sold to Y. I record what? Good. I record a sale of 100 and what about in your books? a purchase, of which purchase is part of cost of sale. So remember, we consolidate the published financial statement. And for published financial statement, expenses are classified into 4. It's either cost of sale, finance cost, admin, or selling and distribution. So purchase is part of the cost of sale. So that means in your book, you record a purchase, which is part of cost of sales. So you record the same 120. So now during consolidation, we have the same transaction, which affect sales, and in your books is affecting cost of sale. During consolidation, we eliminate them in full. So in my sales, I eliminate 120. Then you eliminate an amount of how much? 120. Then there is an element. You see, in this case, I never transferred the good. I sold the goods because these are totally different businesses. It's only that they're the same group. So that means we made a sale. If you made a sale, that means the company is profit-oriented. You made a profit. What's the difference between a margin and a markup? Margin is based on what? Sales. What about make a markup? Yeah, cost of sales. So how do you determine the profit element? Because in this case, what we need is the unrealized profit. Margin is based on sales. You're told that A sold good to B at a margin of 10, and you want to determine the profit element of 10. A sold good to B at a margin of 10. Just take 10% of 100. Margin of 20, 20 over 100. Margin of 30, 30 over 100. What about markup? A sold, you are given the sales, at a markup of 10. Markup is based on cost, but you're told that because in this case, it would be given intergroup sales. But now you're given the markup. A sold good to B at a markup. So that means you have to convert markup into margin. How do you convert? If it's 10%, you take 10 over 110. A sold good to B at a markup of 20, it will be 20 over 120. A sold, that sales, goods to B at a markup of 30, you take 30 over. A sold good to B at a markup of a third. It will be 1 over. Good. You see what you are doing here? You are just taking this 10, you add it there. So get 10 over 110. Here you are taking that, you add it there, you get that over 130. This being 1 over 3, you just take this 1, you add it there. Good. So therefore, how do we account for unrealized profit? Unrealized profit on closing stock. X, take this scenario, X sold goods to Y worth 120 million at a markup of 20. At a markup of 20. So how much will be the unrealized profit? It will be 20 over 120. Then you multiply by the transaction, which was 120. So you made a profit of how much? 20. How do we adjust for this 20? Now for unrealized profit, you added to the cost of sales, then you eliminated from the closing. For unrealized profit, you added to the cost of sales, you eliminate from the closing stock. And why do you eliminate it from the closing stock? This is what I mean. Here we have X, we have Y. X sold goods to Y worth 120. So how much was the cost of goods in X? It was 100. Because if we made a profit of 20, that means the cost was how much? 100. Now, in books of Y, how much is the cost? It will be 120 because that was the purchase cost. Are you together? So that means Y recognize the cost of how much? But now, if you have to consolidate the two, remember this is the same goods. It's only that the difference is the value. What made them to be different? The profit element. So how do you adjust them? So we adjust this 120 was inclusive of profit. So it means that profit of how much? So that it will be 100. That's why I'm saying that for this unrealized profit, you add it to the cost of sales, then you eliminate it from the closing stock. Good. Then lastly, we have intergroup sale of fixed. asset. Now, in case of intergroup sale of fixed asset, we have two things we have to adjust. Number one is the profit on disposal. Let me call it an realized profit because the profit within the group. And then, since an item of fixed asset, that means the depreciable item. There is an element of overcharged depreciation. X sold an item of plant to Y. Let's assume this asset, the cost was 50 million. Then X decided to sell it to Y. You are selling, so that means you have to make a profit. Nataka nikuzie pesa ngapi? 60, eh? Aya. So X sold an item of PP to Y at 60. The cost was 50. So I made a profit of how much? 10. Now this 10 is what we call the gain on disposal or unrealized profit. Now, how do you account for it? Now, for unrealized profit, you account the way you accounted for this. You add it back to the cost of sales, then you eliminate from what? PP. I repeat again. In case of any gain on disposal of assets, remember you had already recognized a gain. So how do you eliminate that gain? By adding it back as a cost. So you add it to the cost of sales, then you eliminate it from the PP. That means the value of your asset has been overcharged by how much? 60. I mean by 10. Then being an item of PP, assume the group has a depreciation policy of 10%. Assume the group has a depreciation policy of 10%. That means in my books, how much was the depreciation recognized? That's 10% of the cost, which is 10% of 50 is how much? 5. What about the same asset in your books? Now your cost is not 50. Your cost is how much now? So you'll take 10% of 60. Show a depreciation of how much? I mean 6. So there's a difference of how much? 1. Of which this one is the same as taking 10%. What caused this difference is this profit you had made. So if you take 10% of this 10, do you get this one? So how do you account for this overcharged depreciation? Now for the overcharged depreciation, the opposite of this, you add it back to PP, then you eliminate it from the cost of the opposite of this. You add it back to PP, you eliminate it from the cost. I want you to give you 2 minutes. You can even take a screenshot of that. If you have any question, ask before you do now an illustration. And this is very important for depreciation. If you want to, to understand consolidation, understand the 3 concepts: intergroup balances, intergroup sales and realized profit, and then intergroup sale of fixed assets. Now let's do an illustration. June 2011, question 1. June 2011, question 1. If you have the notes, the question is already there, well scanned. you don't have the notes, you can now use the past paper. June 2011, question 1. Yeah. So now let's do that question. Host Limited, its subsidiary Super Limited and subsidiary Sport Limited operate in the media industry. So already have the group structure. That's a vertical structure. You do that. Host Limited, its subsidiary Super Limited and subsidiary. So we have Host, its subsidiary Super Limited and subsidiary Sport operate in the media industry. The following financial statement relate to the three companies for the year ended that 1st of December 2010. So we have the income statement, we have the statement of financial position. Additional information. Number 1. Host Limited acquired 90% of the ordinary shares of Super Limited on 1st of January 2005, when the retained earnings of Super Limited was 1425. That's what we call the pre-acquisition retained earnings. So Host acquired Super 90%. How much is the non-controlling interest? 10%. Good. Subsequently, Super Limited acquired 80% of the ordinary share capital of Sport Limited on 1st of January 2007. That's after 2 years, when the retained profit of Sport Limited were 950. So subsequently, Super acquired Sport 80%. So that means Sport is a subsidiary to who? Super. Now, how does Host, remember Host is now is the company which consolidates the financial statement, right? Host Limited. So how does Host control Sport? 90% of 80%, which is 72%. How much is the non-controlling interest? 28%. Good. Number 2. During the year ended that during the year 2010, Sport Limited sold good. Sold good. What is that? Good. That's what we call intergroup sales. They are told that during the year 2010, Sport sold good to Super. Sport sold good to Super Limited at selling price of 480. Now, this 480 is what we call the intergroup sales. And you see that for the intergroup sales are eliminated in full from both sales and cost of sale. Yeah. During the year 2010, Sport Limited sold goods to Super Limited at a selling price of 480, making a profit of 25% on cost. 25% on cost. Margin markup? Markup, good. So now let's get the unrealized profit. It's 25, so it will be 25 over 120. But what we need is unrealized profit on closing stock. Then you are told that 75 million worth of this good was still in inventory of Super Limited at the end of the year. So they held 75. Now the question is, of the good remaining unsold, there is a profit element in it. We have not yet realized. That's what we call unrealized profit. How much is it? Yeah, 15. How do you account for unrealized profit? You add it to the cost of sales, you emit from the closing stock. Then the last sentence of number 2, I told that Super Limited still owed. What is that? Super Limited still owed Sport Limited 100 million. Sioni madeni. That's what we call intergroup balances. Good. So there was intergroup balances. They still owe each other how much? 100. And you see that for intergroup balances, they are eliminated from both account receivable and account payables. Good. Number three, I told that. During the year 2010, Super Limited sold goods to Host. Another intergroup sale. Super Limited sold to Host. Super sold to Host. Subsidiary sold to the parent. That's what you call an upstream sale. Yeah, during the year 2010, Super Limited sold goods to Host Limited at a selling price of 260, making a profit of a third on cost. That's markup. So let's get the nearest profit. So it will be 1 over. Then I told that 60 million worth of these goods were still in inventory of Host Limited as at the year end. So a quarter of 60, you get an amount of 15. Good. Then you are told that Host Limited still owed Super Limited 50 million, still owed. That's all an intergroup balance. It's an amount of how much? So that means the intergroup balances is 150. You eliminate from both account receivable and account payable. Then 15, how much is the total? That is for unrealized profit. You added to the cost of sales you made from the closing. Then there is intergroup sales. Sport sold to Super, Super sold to Host. How much is the total? 37. 480 plus 260 is 740. For intergroup sales, you eliminate them in full from both sales and cost of sales. Good. Number four. During the year, Host Limited sold an item of plant. Plant is an item. What is that? Intergroup sale of fixed assets. And they say that whenever you have an intergroup sale of fixed asset, you have two things you need to adjust. One is the gain on disposal, and number two is the overcharged what? Depreciation. During the year, Host sold an item of plant to Super. Host sold Super an item of plant at a selling price of 240, reporting a profit of 20% on cost. That's markup. So it will be 20 over 120 of these 240. So that means you made a profit of how much? 40. How do you account for this 40? It's the same as this, and here is profit. You add it back to the cost of sales. You eliminate from what? You eliminate from PPE. Now let's determine the element of overcharged depreciation. The group charges depreciation at the rate of 20% on costs, and this is included as part of cost of overcharged depreciation. The group charges a depreciation of 20% on cost. So you take 20% of what? Of these 40, the profit they made, you get an amount of 8. So how do you account for this depreciation? This is the opposite of this. You add it back to PPE, deducted from the cost of. There's someone saying that we are told on cost. This is what I mean. We have Host, we have Super. Host sold an item to Super at a price of how much? 240. And made a profit of how much? 40. If you sold at 240 and you made a profit of 40, how much was your cost? The cost was 200. But Super incorporated at a cost of 200. And so this 40 is what we say that you added back to the cost of sales, you eliminate from PPE. Then you're told that the group charges a depreciation of how much? 20. So depreciation is 20% on cost. 20% Host cost was how much? So they'll show a depreciation of how much? 20% of 20 is how much? 40. Super, the cost is 240. So they'll charge 20% of 240. You get 40? There's a difference of how much? 8. And that's what we're doing here. You take the 20% of this gain on disposal. So you add it back to the PPE, and then you deduct it from the cost of sales. Number 5. The entire goodwill of Super Limited has been impaired. You cannot impair goodwill before determining how much was the goodwill. So let's compute goodwill. How do you get goodwill? Correct. Now, who is consolidating the financial statement? Host. So that means is the host determining the goodwill on Super Limited and Sport. Now, the goodwill of host in Sport will totally be different of goodwill of Sport by Super. Super is the one acquired Sport. The difference between the purchase consideration of Super and Sport will be different from now what host paid to acquire who? Sport. So, umeshika kitu. This is Super Limited. This is Sport Limited. So to get the goodwill, you take the purchase consideration, you raise net asset acquired. How do you get the purchase consideration? Let's go to the non-current asset. Non-current assets. Non-current assets. Can you see investments? How much was investment in Super? It was an amount of 66. How much was investment in Sport? 3,800. Who acquired Sport? Can you look where the cost is? You see this 6650 is by host. This 38 is by who? Super, but we are computing the goodwill by the parent company. So how do you determine that? This is what I mean. Super paid Sport 3,800. Now the question is, parent contributed how much? Because we are computing goodwill by host. If Super paid Sport 38 and the parent controls Super 90%, so that means 90% of this came from the parent, not about 70, not 72. 72 is the control. Are you together? So of this 38, 90% came from the parent, because if Super paid Sport 38, of which Super is being controlled by the parent 90%. So that means the 90% of this 38 came from the parent. How much is that? That's for? That's for 20. Then you raise the net asset acquired. You see that for the net asset acquired, you look at the equity items. Let's go to the equity. Go to the equity. What do we have? We have ordinary share capital. Ordinary share capital. How much is for Super? 3,000. Sport? 2,000. What else do we have? Retained earnings. But you see that for retained earnings and other reserves, you take the pre-acquisition. Note number 1. So you take pre-acquisition retained earnings. And note number 1 here too, that Host Limited acquired 90% of the ordinary share of Super Limited on 1st of January 2005, where the retained earnings of Super were 1425. This was 1425. Subsequently, Super Limited acquired 80% of the ordinary share capital of Sport Limited on 1st of January 2007, when the retained profit of Sport were how much? So these were the total net assets. This is 44.25. This is 29.50. Then here use partial goodwill method. Why? Okay, how to determine whether using full or partial? For full goodwill method, it will be given the NCI fair value. If you're not given NCI fair value, you use the partial goodwill method. So, Host controls Super 90. These were the net asset acquired, of which we are controlling 90%. So how much is that? That 982 point. Now give me the goodwill. You take the purchase consideration 6650 minus that. Sorry? 0.5. Spot. Net asset is 2950. You multiply by the control. How much are you controlling of this net asset? Good, 72%. So 72% of that is how much? 21? 24. So how much was the goodwill? 1296. Now we can answer part, we can go to part 5. We adjust part 5. I mean, note number 5. Note 5, we are told that the entire goodwill of Super Limited had been impaired. This goodwill of Super has been fully impaired. The entire goodwill of Super Limited has been impaired. And by that 1st December 2009, when was that? Let's go to the required. You look at the reporting dates. Yeah, the year ends on that 1st of December 2020. Eh? But here I told that. And by that 1st December 2009, when was that? That's the end of last financial year, eh? Which is the same as the beginning of the year. Yeah. As at that 1st December 2009, 60% of goodwill of Sport Limited was impaired. So that means by the end of last financial year at the beginning, 60% of this has already been impaired. So impairment. So 60% of 1296. So how much was accumulated impairment? 777. So how much is the balance? So the balance will take 1296 minus 77.6. How much will be the balance? 518.4. Good. So that was the value of the goodwill at the beginning of the year. Then you are told that an additional half of the balance of the goodwill is considered impaired. The group uses partial goodwill method. An additional half of the balance is considered impaired. So that means it's what we call impairment for the year. So how much was for the year? An additional half. So you take 518.4 divided by, yeah, that would be the impairment for the year. 259 point. Now this 259.2 being the depreciation charge for the year, you'll take it to the income statement as an expense. Then to the balance sheet, how much will be our net goodwill? At least. Umeelewa swali langu? How much will be the goodwill to be shown in the financial statement? Sasa tusikize hapa because naona kabisa amfikiri. Watu wanamfikiri. Umefikiria kweli hapo? Hamkufikiria, hapana. Now, how much was the goodwill at the beginning of the year? 5? Ndio ulichukua 1296 ukatoa the 60%, eh? So the unimpaired goodwill was 518 point. Then, so that means this was at the beginning. Then half of it was impaired during the year. So how much is the balance? Let me tell you what, I told you I'll not be in an exam to explain that to you. Because mnaelewa after mmeelezewa. If half of it was impaired, so that means the balance is what you go to the balance sheet. So this one you take it to the income statement as the impairment charge for the year. Then the balance, the other half, which is the same, 259.2, you take it to the balance sheet as your net goodwill. Required. Consolidated income statement for the year ended that 1st December 2010. Now, who will consolidate? Host, good. So the parent is host. So it will be host group, not limited. Then we prepare consolidated income statement for the year ended 31st of December 2010. Just copy paste what we have. You see that you consolidate only subsidiary. All of them, they are subsidiary. So to the income statement, we have revenue. Then you raise cost of sales. And that's how you get your gross profit. So for the revenue, we have 35. Sorry, it's 45. 45,600. Then you add 24,700. Then you add 22,800. Cost of sales, we have 18,050. You add 54,63. You add 53,20. Then we say that for unrealized profit, you add it to the cost of sales. So we had this 30. Also, there was gain on disposal. Also to super, made a profit of 40. You added to the cost of sales we made from the PPE. So you add 40 minus for overcharge depreciation, you added to the PPE, you eliminate from cost of sale 8 minus. Intergroup sales are eliminated in full from both sales and cost of sale, intergroup sales. Spot sold good to super worth for 80, super sold to host worth to 60. The total was how much? 740. Kindly don't consider this, the intergroup sale of fixed asset. This one is not part of revenue. This one is not part of the revenue. So give me the adjusted amount. $92,360. Cost of sales. $28,655. Now let's get the gross profit. 151, 155. 64. 205. Good. Now, once we have the gross profit, now we can deduct the expenses. Now, for the expenses, there is a distribution cost. Then there is an administrative expenses. Then there is finance cost. Then there is impairment charge for the year. Now, for impairment charge, you add it to the admin expense. But to be on the safer side, recognize it as a separate item, so still allowable. I repeat again. Remember, I said that we consolidate published financial statement where expenses are classified into 4. It's either cost of sale, admin, distribution, of finance. Impairment of goodwill qualifies to be part of admin expenses. But for consolidation purposes, you can also include it as a separate item. Why? Because high chances you'll get around goodwill. If you get around goodwill, what will happen to the impairment? Will be wrong. If you transfer a wrong figure to the admin expense, what will happen to admin expense? We don't mark working. We mark the entry, so still will be wrong. So kindly can you indicate it as an impaired, as a separate item? Kama itakuwa wrong will not affect your admin expenses. So we have impairment of goodwill. So distribution cost, we had that 325. Then you add 2137. And then we had 1900. Admin, you have that 475. Then you add 950. You have 950, then you add 1900. Finance cost is only for the parent, 325. And then impairment of goodwill, the charge for the year only, 259.2. Give me that. 7362. 6325. Now let's get the profit before tax. You get 933.8. Then we raise tax. That was the profit before tax. We raise the tax expenses. Income tax expense, we had 83. Then you add 53.90. Then you add 42.41. You get 17? 9? 9 that one. Now give me the profit after tax. Sorry? That's how we get the profit after tax. Then you can show attributable to number one, to the parent company, and then to the non-controlling interest. Let me just show you that. Profit attributable to NCI. So we have two subsidiaries. Therefore, we have two non-controlling interests. One is in super. We are controlling super 90. So the non-controlling interest is how much? 10. Then we have sport. Sport, we are controlling 72%. How much is the non-controlling interest? 28. So you'll take, for example, for super, 10% of their profit after tax. Let's go to the income statement. Not this profit after tax, of their specific profit after tax. Super, how much was the profit after tax? 10,760. Sport? 9430. Let's adjust. Let's be here. Let's adjust. Sport sold good to super and made a profit of how much? So sport sold to super made a profit of 15. That means of this profit of sport, there is an unrealized profit of 15. You eliminate. Super sold to host, made a profit also of 15. Super sold to host. That means this profit of super is inclusive of an unrealized profit of how much? 15. Host sold an item of PPE to super. So who made the profit? Host. Who overcharged the depreciation? Super, good. Overcharged depreciation by how much? 8. So the depreciation was overcharged. So that means they recognized more expense. So more expense, what will happen to our profit? We reduce. So you add it back. Give me that now. You're getting? You are saying? Was for, yeah, it was for super. Yeah, it's super, not sport. Good. The overcharge was for super. You add back 8 there. Yeah, you get? 10%. 1075.3. What about 28% of that? Sorry? 2630.72. Now let's add the total. Sorry? 0.00. So that's the profit attributable to NCI. So profit to NCI is an amount of that 714.02. So how much do you attribute to the parent? Just take the difference. That 2002.8, you raise the profit attributable to NCI. 28.78. For those taking a screenshot, they can take a screenshot. We do now the balance sheet. We still have time. Now you prepare the balance sheet. Though what we are doing is already in your notes. There's no need to fill your gallery. So consolidated statement of financial position. So let's start with the assets, non-current assets. We have PP. So we have 35, 483. Then you add 24, 273. Then we have 13, 063 plus 8 minus 40. For unrealized, for overcharge depreciation, you see that you added to PPE. Then for unrealized profit, you deducted from. Give me that. I know you are tired, but we have to finish it. Because we don't have to finish, I'll have to start from scratch next class. I know you better. I'll be asking, how do we treat intergroup sales? Kila mtu anaangalia chini. 72, 780, 787. Then we have investment in super and investment in sport. Those were the purchase consideration. Now, for the purchase consideration, you recognize the goodwill. How much was the goodwill? 259.2. There is someone who will ask, where did that 252 came from? I told you understand you better. So what do you have to the current assets? We have inventory. We also have account receivables. And then we have cash and cash at bank. Now for the inventory, we have 462. And then you add 4265. Then that 682. Then there is something we need to eliminate from inventory. What is that? Unrealized profit. Good. You see that for unrealized profit, you added to the cost of sales, you eliminate from the closing stock an amount of 30. Then we have trade receivable, 884, that 824, 2864. Then you eliminate what? Intergroup balance. You see that for intergroup balances should be eliminated from both account receivable and account payable. How much was the amount? 150. Then we have cash at bank. So give me that. 83, 70, 79, 22, 95. Now let's add the total. Give me the total assets. Sorry? 90. Good. Now we go to equity and liability. For the equity and liability, we have ordinary share capital. For ordinary share capital and share premium, you don't consolidate. You only take for the parent, which is an amount of 8,000. Then we have retained profit. Retained profit. And then you also need to recognize the element of non-controlling interest. Let's go to the non-current liability. Non-current liability we have loan from bank. It's only for the parent, an amount of that too, 50. Then we have the current liabilities. For the current liability, we have trade payables, as well as we have current tax. So trade payable, we have it 73.13. Then we have 82.23. Then we have 28. Then we eliminate 150. Then for the current tax, you take 2,500. Then you add 1,800. Then you add 20. 2, 3, that's 43. 20. What about for payables? 15? 15? 414, So now you're remaining with the two items, that's retained earnings and NCI. Should I show you? Yes. As you wish. Now let's start with the retained profit. So how do you adjust for retained profit? These are reserves. Now for reserves, you start with parent retained earnings. How much was the parent retained earnings? 22, 630. But parent is host. Host sold an item of plant to super. Had made a profit of how much? So that means that 40 is already included here. So you eliminate. So how much was the adjusted profit? 22.5. 598. Then we add investee share of post acquisition retained earnings. Investee, be it a subsidiary, be it an associate, we add the post acquisition. So here we have two investee. We had super, we had spot. We are taking the investee share. Host is controlling super 90%, so you'll take 90% of the retained earnings. Then host is controlling spot 72% of their retained earnings. So how much is the retained earning of super? Yeah, 24,070. And for spot is an amount of 19,890. But you have said that investee share of post acquisition retained earnings. Now this is what we have now. If you want to get the post acquisition, you eliminate the pre-acquisition. Here it is. Pre-acquisition retained earnings. At the date of acquisition of super, how much was the retained earnings? 1425. And for spot was an amount of 950. That was note number 1. Is 950. So that you get now the post-acquisition retained earnings. Then we adjust. We have not yet done adjusting. During the year, there was intergroup sales. Spot sold to super made a profit of 15. Super sold to host made a profit of, we eliminate 15, we eliminate 15. Host sold to Super an item of PPE. Host made a profit of 40. That means Super overcharged depreciation by how much? 8. So you add 8. First of all, give me that. I will still have time. The longer I will take, I'm enjoying this. So it'll keep me company. Sport, 13.76. Sorry? 2078.7, Good. Then we raise impairment. So that means if your goodwill was wrong, also impairment will be wrong. If the impairment will be wrong, retained earning will be wrong. So how much was the impairment? Super Limited, the goodwill was fully impaired. So an amount of 2667.5. Sport Limited, at the beginning of the year, 60% was impaired. How much was 60%? 777 points. Then during the year, an additional half of the balance. How much was that? 0.2. So how much was the total impairment? The longer you take, that's 7.3. That one we deduct. Now give me the retained earnings. Sorry? 52,904.16. So that means the retained earnings 52,904.16. So now remaining with NCI. Let me show you to get NCI. You said you want to be shown how to compute them. Let me show you. This is how we get NCI. We have two non-controlling interests. One in Super, the other one in Sport. 10%, 28% of their net asset. So you take the net asset. Let's go to the equity. Super, how much the ordinary share capital? 3,000. How much the retained earnings? 24,075. We do the same for Sport. We want to determine the net asset, then we take the proportion of the net asset. So Super, Sport, how much is the ordinary share capital? How much retained earnings? Yeah, 19,898. Now, these are the retained earnings. We adjust retained earnings. How do you adjust? There was intergroup sale. They made a profit of 15.15. Then Super overcharged depreciation by 8. You add it back. Give me that. The first one is 27.8. I hope that's 10%. What about Sport? It's 177.27.24. Then you raise investment in Sport. Investment in Sport. Let's be here. Super paid Sport 38, right? That was the purchase consideration, 38. But when determining the goodwill, the parent contributed how much? 90%. Where did the other 10% came from? Non-controlling, yes, which is an amount of 380. So how much is that? 84.04. So here we have 84.54.04. Now try to balance. You get 92? A quick advice, eh? Don't do consolidation to balance. Are you together? It's only JOHNMARK who is allowed to do what? Yes. When I say it's only me, actually I'm the only one. Not even the other lecturer. The other lecturer wanafanyanga just nini. Anasema hiyo tuachie. To balance this thing is not that simple. Eh? So in our next 2 or 3 classes, we'll be still be covering consolidation. Now, the good thing, I usually do tell my students, during exam, this is what most of my students usually do as the first question. Exam ikikuja anatafutanga mahali group iko. Hiyo nafanyanga as the first question. Because this is one of the easiest. Don't be discouraged by the first question. Are you together? Yes. By the end, by the time you are completing this topic, I've done like 8 questions. And then during revision. So, actually, this should be, you should do this one as the first question, followed by cash flow. Reconstruction, the last one.